Welcome to SB News Podcast. We look at the fundamental aspect of the economy and its impact on the Forex future and the stock market. Any opinions expressed here are for information purposes and must not be taken as investment advice. The European Central Bank hiked its interest rate by 25 basis points on Thursday. This brings the deposit rate to a record high that was last seen during 2001. While this is the ninth straight increase of interest rate for ECB, the autopilot increase in interest rate may be coming to a halt for now. ECB President Christine Lagarde stated more interest hikes are possible if inflation and price pressure remain high. Interest rate hike indicates that inflation is not yet at the 2% medium target rate, an ECB's objective with regards to inflation. However, many policymakers believe interest rates will stay unchanged in September's meeting. While the European Union economy remains weak for now, it is expected to recover over time. Consumers and businesses are spending less, and over time, with lower inflation and higher income, the economy is expected to pick up pace. The service sector, especially tourism, is performing well while manufacturing is going through slow growth due to weakening demand from rest of the world. On Friday, France and Germany release weakening CPI, leading many to believe inflation may come down to ECB's target sooner than later. The Governing Council also resolved to set the minimum reserve remuneration at 0%. The adjustment will take effect on September 20, 2023, at the start of the reserve maintenance period. This means that the ECB will no longer reimburse banks for the money they must retain as a minimum reserve. Banks typically generate a large amount of income from the minimum reserves they keep, and without this income, they will need to find other sources of revenue to compensate for the loss of income. In U.S., an estimate released by the Bureau of Economic Analysis, U.S. GDP increased by 2.4% in the second quarter, surpassing the 2% increase of the first quarter. Although today's GDP release is susceptible to revision, especially since the source data are incomplete, this has raised a sense of optimism in the market. Consumer spending and non-residential fixed investment, which includes commercial real estate and equipment, drove economic growth in the second quarter. Housing and utilities, as well as healthcare, accounted for most of the service spending. Along with today's favorable GDP figures, the Department of Labor announced 221,000 people filed jobless claims in the week ending July 22, the lowest number of claims since February. Unemployment claims fell from June's 228,000 level and also came below forecast of 234,000. Despite favorable figures, the effect of tightening monetary policy may restrain economic activity in the coming days, and we could see slower growth in the rest of the year. The Bank of Japan declared that it will not alter its control over the yield curve or its monetary policy. Every business day, the bank will make an offer to buy 10-year Japanese government bonds at 1% through fixed-rate purchase operations. The bank will continue to make large-scale government bond purchases and will respond quickly to each maturity in order to keep the 10-year yield at the target level. The bank will purchase a necessary amount of Japanese government bonds without setting an upper limit so that 10-year bond yields will remain at around 0%. With regards to asset purchase, the bank will purchase exchange-traded funds and Japan real estate investment trusts as necessary, with upper limits of about 12 trillion yen and about 180 billion yen, respectively. With extraordinarily high uncertainty surrounding economies and financial markets both at home and abroad, the bank will calmly maintain monetary easing while reacting quickly to changes in economic activity, prices, and financial conditions. It will do so in order to attain the 2% price stability target in a sustained and stable manner, complemented with wage rises. The bank will maintain quantity and qualitative easing with yield curve control in order to attain the price stability target for as long as it is required to do so in a steady manner. It will keep growing the monetary base until the year-on-year rate of growth in the observed CPI exceeds 2% and remains steady above the objective. You are listening to SB News. Don't forget to subscribe, like and download our podcast. It helps us bring more contents like this to you. Fundamental analysis of economy for Forex, future and stock market.